On behalf of the Kansas Department of Agriculture, good afternoon to those logged in, and thank you for joining our webinar. My name is Dr. Mark Olson, and I am the Northwest North Central AFI Inspector for the AFI program. During the presentation portion of this webinar, all participant microphones will be muted. If you have a question during the presentation, please submit your question using the Q&A button at the bottom of your screen. The chat function will not be accessible. Submitted questions and comments will be monitored by the Kansas Department of Agriculture staff. At any time during the webinar, when asking a question, please include your name, city and facility, business, or nonprofit organization, if applicable, so that we may easily answer your question. The webinar is being recorded today and will be posted online for all participants. As much as possible, the presentations will also be posted online. Please note that this presentation will be recorded today. It is with great pleasure we welcome Adrienne Heard. Ms. Heard has a BA in Personnel Management from Michigan State University, an MBA in Management and Finance from the University of Dayton, and an Ohio Certified Business Advisor designation from the University of Toledo. Heard Management was formed in 1993 to provide planning and staff development services on a consulting basis. Heard Management is a minority female-owned sole proprietorship consulting firm specializing in management consulting services. In 2003, Adrienne was recognized by Leading Women Inc. of Cincinnati for her contributions in the field of entrepreneurship. Adrienne is the author of Quick and Smart Entrepreneur's Handbook, published by Hollandaise Publishing. Let us welcome Ms. Adrienne Heard.
Thank you, Mark. At this point, I'm going to attempt to share my screen. So if you'll just bear with me, I think we're there. Today's session is on record keeping for the small business, and it's geared specifically for small businesses in Kansas. So let's see what's going on. Okay. Our agenda. First, I'm going to go over some general information. I'm going to touch just a little bit on tax considerations. We're going to spend most of our time talking about business expenses and record keeping. So if everybody's ready, let's get started. And remember, if you have any questions, put them in the Q&A section. The basis of today's session is taken from IRS publication 583, Starting a Business and Keeping Records. Now, because you all have already started your business, we're not going to go from the very beginning. We're going to start down with accounting method, okay? So there are two acceptable accounting methods, and it doesn't matter which one you use, as long as you use it consistently. At the end of the year, when you file taxes, they'll ask, do you use the cash method or the accrual method? The cash method basically reports your income when you get the money and reports your expenses when you pay the bill. It's like keeping a checkbook. It only follows the movement of cash. And this works okay if everything that you buy as far as supplies is used in the same month that you buy it. And if everybody that you work for or pays you immediately. The accrual basis reports the activity instead of the cash. It reports your income when you earn it, and it reports the expense when it's incurred. So for example, if you have a major account that you bill at the end of the month for everything that's happened, it will recognize that invoice as income. And if you put a lot of stuff on a credit card that you pay when the bill comes, it will recognize that you did incur the expense, even if you haven't paid it yet. As I said, both methods are acceptable. It's just whichever one you choose, the one that works best for the way you do your business activity, and you stick to it. Now let's talk just a little bit, as I promised, about tax considerations. First, let's talk about sales tax. Sales tax is not income. And when you pay sales tax, it's not an expense. You are acting on behalf of your state. If you sell a service or a product that is subject to sales tax, and you should have a vendor's license, you collect sales tax at the time that you sell it. And then once a quarter or once every 6 months, you remit the sales tax that you've collected. You send it to the state. Now, what happens if you forgot to collect it? Too bad, you still owe it. For easy math purposes, you have a service or a product that you sell that's $10. Your sales tax is 5%. So that means you charge $10.50. $10 goes into sales and 50 cents goes into accrued sales tax. You have a product that's taxable that you sell for $10 and all you collect is $10. Ha ha. That means $9.55 goes into sales and 45 cents goes into sales tax because you still owe it. And it's important that you pay it in a timely fashion because if you don't, the penalty could be more than the sales tax that you owe. Same with business tax. Business tax is paid on the net revenue for the business after you've deducted all of your expenses. And if you spend a little time keeping track of your expenses, your business tax will be lower. Here again, pay it when it's due. The penalties can be greater than the tax that's owed. And then self-employment tax, for those of you who own the business, if you have ever collected a paycheck from someone and you notice how they deducted stuff, FICA, stuff like that, well, they deducted it and the same amount that they deducted from you, they had to pay. If you're self-employed, you are the business. So therefore, you have to pay the full amount. The amount that your previous employer deducted that you paid, and the amount that the employer paid, the matching amount, because you're the employer. So let's talk about employee taxes. You've got the FUTA and the SUTA. That's the federal unemployment tax and the state unemployment tax. You got FICA and M, which is Social Security and Medicare. You've got workers' comp. You also have withholding. None of this is money for you to play with. I recommend that you always use a payroll company because the time you spend figuring out these little taxes and keeping track of them, it's better to have someone who does it for a living. And it's not that expensive when you think about the time you would spend. FUTA, federal unemployment tax, state unemployment tax. Federal unemployment tax is a set rate. State unemployment tax varies based on your industry and you. If you get behind on paying your state unemployment tax, it will put you in a higher rate, and that higher rate continues until such time as you bring your unemployment taxes current, and then they don't give you a refund just because you're now current. So don't fall behind. Workers' comp, is also based on your industry. And one of the things I'll tell you, people, they try to make a distinction between employees and independent contractors. If you have someone who gets injured on the job, the first thing the hospital or medical center or urgent care is going to ask them is, was it a job-related injury? In which case, the claim goes to workers' comp. If you have not been paying workers' comp or have not been claiming employees on workers' comp, that's how you get caught. Workers' comp. And if you are a one-person office, you can have workers' comp on yourself as owners, owners workers' comp. Withholding, that's when you again act as an agent for the federal and the state government, and sometimes for city and school districts, and you withhold the employee's income tax and so that you can remit it to the state on their behalf. Again, this is not your money to play with. I recommend that you go ahead and have a payroll company handle everything for you, and you go ahead and you pay it at the same time that it is incurred. The reason being, if you don't have the money to pay it now, and you says, well, I'll just pay it later because I'll have more money later. And later comes and you don't have more money, well, that's when you get into that penalty. So now I've talked about taxes and I'm through. Let's talk about business expenses. One of the handouts you should have received is 100 typical business expenses. Now, when you look at this list, there are some that will not apply to you, but there are some that probably do and you hadn't thought about it. If your company has vehicles and they're used almost exclusively for the company and they're in the company's name, then you have automobile expenses, gas, tires, oil, stuff like that, depreciation. If you use a personal vehicle to do anything for your business other than going from home to the business, you can still deduct things, but what you deduct is mileage. Mileage. Mileage is a non-cash expense. However, it does become a cash expense if you write a check to reimburse people for their mileage. You can write a check to reimburse yourself for mileage, or you can just simply at the end of the year take off mileage as an expense. But you must track mileage if it's on a personal vehicle and you want to use it as a business expense. If it's a personal vehicle, you can't do gas, you can't do car insurance. That's all covered in the mileage. And every year the federal government tells you how much your mileage allocation is. You can track it on in a logbook. There are different applications that go on your phone. I don't care, just track it. It's money that you're throwing away if you don't. So the way you use this chart is that you go down and you look at everything on here and you say, yeah, this is an expense I have. And you put down how much and how often. If it's not an expense you have, make sure that it's not an expense you have before you cross it off. I may have left something off. So if I left something off in your business, add it. Let's talk about capital equipment. And that's the big stuff. I know you bought some furniture. You bought 10 chairs for your waiting room, but each chair only costs, what, $40? You can't put down $400 in chairs. That's small equipment. Capital equipment is the big stuff. It's the equipment that you use to manufacture a product, provide a service, or you use to sell, store, and deliver merchandise, and it's going to be used longer than a year. It's your X-ray machine, okay? It's the big stuff. It's not equipment that you're going to sell in the normal course of business. That's inventory. Depreciation is a made-up term, and the reason they made it up is because I'd never buy a piece of equipment if it was going to make me go in the hole. And they says, well, if a piece of equipment is going to last 10 years, let's just say that I've used 1/10 of the value every year. 1/10 of it is used to generate income because it's going to help me generate income for 10 years. So the fancy way of saying it is that it's a method that allows you to write off the cost of capital equipment and other fixed assets over the expected useful life of that equipment as a non-cash expense. It is not cash. Depreciation is just a method that's used to spread the cost over several years. Now, sometimes it gets a little confusing because based on your management decision, if you decided to pay cash for it up front, fine. But sometimes you get a loan, and if your bank loan is usually for the expected life of the equipment, because the bank's not going to loan you money for longer than something's going to last, your payment might be the same as what we've calculated your depreciation, but they're two different things. A loan payment, the only part that goes on the expense account is the interest, because that was management's decision. The payment of the principal goes on the balance sheet. Depreciation is what says 1/10. And of course, the federal government tells you how long something's going to last. So if you take good care of your equipment, regular maintenance, you might stretch it out so it lasts longer. And so your expenses over the extended life, your balance sheet will look better. If you don't take good care of your equipment and you need to replace it before it's fully depreciated, before its expected useful life, you have to show a loss on the disposal of fixed assets. And you don't determine the expected life. The federal government has a nice little chart where they tell you the expected life of various types of equipment. And there are different methods of depreciation. You can do something's going to expected life is 10 years. They can do 1/10 a year, or they can do a bunch at the beginning and a little. These are all things for your accountant. You just need to understand the concept. Okay? Now let's talk about that stuff that you sell. That cat food for cats that have kidney problems. All of that stuff that you have on the shelf, that's inventory. Inventory, merchandise that you held for sale in the normal course of business. It's the sale of inventory that provides a business with this main source of revenue, unless it's a service business. And all of you are service businesses, and some of you are service and inventory if you sell, products for the pets. Now, this is what we came for. We're going to talk about record keeping, which is also known as paperwork. And it is the least fun part of any business. And it's also the reason that businesses get in trouble. Stay on top of it. Why? Well, you can monitor your success. You can prepare financial data that'll be based on facts, okay? You can prepare your tax returns. And when you keep records, you can track your deductible expenses. Because my goal is not to pay a penny more than I have to, but to be honest in what I'm doing. So track your deductible expenses. Bookkeeping? Well, the IRS requires it for taxes, but for those of you who've ever looked at the tax form, it's only interested in your income. And it summarizes a lot of it, but you still need to have records. You do bookkeeping. So why else do you do bookkeeping? Well, banks review it. They review it for financing and for credit. And banks look at more than just your income statement. Banks look at your balance sheet as well. The balance sheet tells them what kind of money you have in the bank, what you have in reserves, and how you've used your money. The bank also tells them that irregardless of how good your income statement looks, it looks to see how much other debt you already have to know that are you generating enough revenue that you can pay your existing debt plus theirs. So they go into a little bit more detail than the IRS. And then finally, good managers use it because bookkeeping gives you information to run your business. Bookkeeping provides the data. That's a collection of facts. Information is facts that have been interpreted so you can make decisions. But without the facts, your decisions are baseless. So good managers use bookkeeping so that they can get good information to run their business. And the information will be at a much more detailed level than the banks or the IRS, but they'll all have the same totals. Now, there are certain requirements of a good record keeping system. Simple to use. Simple to use is in the eye of the beholder. If you're not able to use it, you won't. Simple to use, easy to understand, reliable, accurate, consistent, and timely. Simple to use, easy to understand, accurate, reliable, consistent, and timely. It doesn't do me any good to find out in December that I was losing money since June. You need to review them regularly. So let's talk about some of the different record keeping systems. Because remember, I said simple is in the eye of the beholder. There's a record keeping system called Dome. There's Excel. There's QuickBooks. There's Sage 50. There's Customized. Dome is the easiest. And it comes in weekly or monthly. But because the world runs by month, I recommend that you use the monthly record keeping. Now, everything is done manually, but what I like about Dome, it explains what you're doing and how to do it. It gives you shortcuts or keys on how to summarize things. And if you're using this, make sure that you put everything, all the records in a monthly, like a monthly envelope or a monthly folder, so you can go back and forth. The challenges with Dome is that you got to do a lot of adding. There are other manual bookkeeping systems. For example, Adams has one as well. But if you'll notice on Adams, they have something on the front that says, similar to Dome. So why would I say that I'm like somebody else as a selling point? That tells me that somebody else must be pretty good. Let's go up a level. Are you good with the computer? Back in the day, we used to use these green sheets of paper. Remember? Columns. You could get anywhere from 4 to 12 or 13 columns. Well, if you've been doing that, hey, let's convert it to an Excel spreadsheet. The nice thing about Excel, better than Dome, because it'll do all the adding for you. Add them down and add them across. Add them down and add them across. Okay? Simple. The next thing is QuickBooks Pro. Now, QuickBooks is a bookkeeping system and it will generate reports for you. And it will generate excellent reports. The challenge with QuickBooks, though, is that it recognizes that you're not always sure what you're doing and you've got to get things done. So QuickBooks, if you're not sure what you're doing, it'll let you print a check and it'll put the other side of the check into to be reconciled. To be reconciled. I had a client who paid taxes on $30,000 that they hadn't earned because of the errors that were in the to be reconciled. You've got to get it done, so go ahead and get it done, but make sure that at the end of each month, you have handled those things that you didn't have time to think about. If you're using QuickBooks, I got a hint for you. Remember, QuickBooks was written by the programmers. And often, if you have a question, you almost need to know the answer in order to look it up. So there are books called QuickBooks for Dummies. Don't be insulted, be honest. QuickBooks for Dummies assumes that you know nothing about accounting, and it helps you figure out how to ask a question. And it may have the same answer in 10 different categories. However you ask the question, they're going to answer it for you. Now, if you're beyond QuickBooks Pro, which is usually enough for everyone, Sage has Pro Accounting, and it was formerly known as Peachtree. Use this if you have a strong accounting background. The reason I say that is that where QuickBooks Pro will let you put something, say, oh, I'll figure it out later. Sage said, you're not going any further until you resolve this. It's called a T-chart where every entry has a counter entry, and accounting software requires you to put in the accounting entry. And then finally, when you've gone beyond this, there are systems that are specifically for your industry. For example, there's a retail management system, also called a POS, point of sale, and a lot of retail businesses use this because it tracks inventory, it tracks sales tax, and it gives you good reports that you can put in your accounting system. I'm certain that there is software that has been customized for your industry. So if it's been customized for your industry, that means that they figured out a lot of the things that happen most of the time and the things that you don't need. And so it's going to be easy to use. The challenge is always to be accurate and current. So now I'm going to talk about taxes again. You can reduce your taxes by keeping good records. You can avoid those late penalties by filing on time. And good record keeping will substantiate your tax filings. You never want to be audited and not be able to explain where a number came from. That's why I said earlier, even though you've entered them, you keep everything. What do you keep? All transactions generate supporting documents. Oh, sometime far in the past, they told us when computers came, that would eliminate paper. No. Supporting documents for income, for purchases, for business expenses. Supporting documents. Income and cash received. You have cash register tapes, bank deposit slips, receipt books, sales invoices, credit card sales slips. And if you get a loan, make sure you have the loan documents. Purchases, cash paid out, cash register tape receipts, credit card sales slips, vendor supply invoices, inventory purchases, checks, and if you loan something to somebody, a loan document. Let's go back for just a moment though and talk about the credit card sales slips. Somebody, sometime in the past, gave the wrong information out and said that your credit card statement would be sufficient. It is not. If there's a Walmart in your area and you go to Walmart and pick up stuff, Walmart, you can get business supplies and you can get personal clothing and you can get food and you can get Christmas cards. You need the individual credit card sales slips that details what you bought. Now, there's some miscellaneous business expenses that might not have a piece of paper. Mileage logs. We talked about mileage as a deductible expense. Bank statements. Well, I keep my business account is in a money market checking account, so I earn interest. That only shows up on the bank statement. Account statements. If you don't pay your credit cards off in full every month, the interest only shows up on the account statement. I have a business credit card with Sam's. There's a fee once a year, I think of $35 to maintain the business account with Sam's. That fee only shows up on the account statement. Petty cash slips. We'll talk about petty cash in just a little bit. But meanwhile, in your petty cash box, you need to have petty cash slips that records what's happening with your petty cash. Loan documents. And if you're anything less than a corporation, we need to track owner activity. Now let's talk about that petty cash fund. You know, that box that's under the front desk that you keep money in to pay stuff that you weren't expecting to come in. And every time it's empty, you just put, another $100 in. Don't know what it went for. Keep a small amount of cash in your petty cash. Write down each payment for the miscellaneous expenses that were paid out of petty cash. You have petty cash slips, okay? And then when you need to put money back in petty cash is just another bucket of money. Your checking account is a bucket of money, your savings account is a bucket of money, your petty cash fund is a bucket of money. When you write a check to petty cash, although you record it as being written to petty cash, you write down that $45 went to postage, $15 went to a coffee for, office supplies. And you get that from those from the petty cash slips. So every time you look if you have decided that you're going to keep $200 in petty cash, at any point in time, you look in your petty cash box and your slips plus the cash should equal the $200. If you have a supplier that will not accept a check or will not invoice you for supplies, they know how much the delivery is going to be. Spend 35 cents and get a money order. Okay? Don't keep a lot of money in petty cash. Now, speaking of that, you need to keep your business and your personal money in separate accounts. They can be at the same bank so that you can transfer between them as needed, but they need to be in separate accounts. So here are my rules for your checkbook. Pay all of your bills by check. Deposit all of your income, your checks and your cash. Remember earlier where I said one of the things that you use to track your income received is your bank deposit slips? It's a lot easier to track it if your bank deposit slips equal the income that you got in. And don't pay any personal bills. If you need to take money out of the business to pay some personal bills, write a check to yourself, or as I do, I've got my accounts linked. I go online and I transfer a flat amount. I don't transfer $98.32. I transfer $100 or I transfer $1,000 and I print off the record that I made the transfer and it's recorded as owner activity. So what happens? We've got this itemized daily record of income and expenses, and we're sure we've recorded everything. That's going to give me a monthly summary of income and expenses. And we're going to make sure we've recorded everything. And we're also going to make sure that if we're using QuickBooks, that the to be reconciled is at 0 because we've reconciled everything while it's fresh in our mind. These monthly summaries are then going to be used to give us our annual or our yearly totals of income and expense. Hey, that's posted to our tax returns, and then it's also used for us to analyze what's going on with our business from year to year and to compare things. Now, one of the questions that I had gotten before was, how long should I keep records? Well, it depends on the record. And since we only had an hour to talk today, I thought I'd give you a handout that comes from the Better Business Bureau. And it's a records retention schedule that came from the IRS. And it's a suggestion of how long you should keep each item. Okay? Now, finally, I want to talk a little bit about some common errors. Common errors. Credit card expense. No. Credit card expense for or a similar account on your profit and loss to record all credit card transactions. No. Remember we talked about accrual? That's just where you delay paying the expense. It's incorrect. Using a blanket account for all credit card expenses doesn't allow you to analyze what those expenses actually were or to analyze trends. The way you fix that is you look at your credit card statement and you break out what each expense was for. If you're using QuickBooks, you can sync your credit card to the transactions that get pulled in. Okay, let's try leasehold improvements as an expense. No, I know you don't own the building, but when you make improvements to the building that you can't take with you, it's not an expense. You can't record those on P&L. Leasehold improvements are considered assets. Expensing them will cause your company to look less profitable and it's going to understate your assets. So remove them from the profit and loss and list them as an asset on the balance sheet. Accounts payable negative? I don't think so. Because if your accounts payable shows a negative amount, that means you double paid a bill. It means that you paid somebody more than you owed them. Now, this could be accurate, but it's probably an error. So you need to look into the payments that caused the negative balance. And if it truly was a payment against accounts payable, what was the original liability entered? So you need to look and see what happened. Loan payment. Remember we talked about the note. The loan payment on profit and loss. No. This will cause your expenses to be overstated, your profits to be understated, and it'll also look like you still owe a bunch of money when we look at your balance sheet. It causes the liabilities, which you owe, to be overstated and the value of your company to be understated. The amount paid on the principal should be recorded as a debit to your liability to reduce your debt. Only the interest should be recorded on the profit and loss, and this recorded as an interest expense. Then let's look at multiple accounts for the same items. I know I got to get it posted, whatever. Well, you realize how confusing it gets when you got multiple accounts for similar expenses. When an expense is not consistent, and remember we said a good accounting system is consistent. When it's not consistently recorded to the same account, it makes it difficult to monitor changes or to identify trends. So look at your accounts that appear similar and have guidelines on what goes into each expense category. And then you can deactivate, or on some systems call it inactive, duplicate accounts to make sure you don't use them again. Sales tax collected as income and paid as expense. Oh, we already talked about that. Make sure it doesn't happen. A large accounts receivable balance. No. That means either you're not collecting stuff or you're not writing off stuff that can't be collected. You need to set a policy for your accounts receivable, and you need to be able to run a list to see who owes you how much and for how long. You want to go after the big boys, but you also want to go after those folks who've been owing you money for a while. Do not serve as a bank for your clients. Expense accounts with a negative balance. No. Expense accounts should hold a positive balance. A negative in the expense means that a transaction was recorded wrong, because the only way it could be a negative was if they paid, you bought something and then you returned it and they gave you more money than you paid for it in the beginning. So look at the expenses that went into that account, the actions that went into the account, and figure out where the mistake is. Personal expense on a profit and loss. I'm not even going to talk about that. We already told you that you needed to not pay any bills. You need to take the money and do it as an owner activity to a personal account and pay your personal bills out of your personal account. On the reverse, if you need a little money to help tide your business over a slow time, that is also recorded as owner activity. Make sure that you record that, because if not, you may be paying taxes on it as income. And then finally, assets not depreciated. Oh, if you don't depreciate them, it results in both your profits and your assets being overstated. It's not a cash activity, but it needs to be recognized. Often, my CPA just recognizes my depreciation once a year at the end of the year. She recognizes it for the full year. If you have a lot, maybe you want to do it every month. That's something for you to talk about with your accountant, okay? And then just a few things to wrap up before we go to questions and answers. An excellent place to get information is irs.gov, their website. I look at websites that have a .gov at the end. I don't use things that come with a .com because they're often trying to sell me something. So irs.gov. As for this publication that I spoke about earlier, IRS publication 583, Starting a Business and Keeping Records, you can find that at irs.gov. Click on Publications, put in 583, and it'll bring it up for you. So let's do a quick review. We went over general information. We talked about some tax consideration. We talked about business expenses and record keeping. Okay, thank you for your time and attention. And now we're going to go to questions and answers. Or questions for sure, answers maybe.
Thank you, Ms. Heard, for this wonderful presentation today. At this time, we'll turn it over to Dana Ladner with the Kansas Department of Agriculture. Dana, have there been questions submitted for our participants today?
There have been, and I will get to those. Adrienne, if you want to stop sharing your screen so we can see your face again, that would be wonderful as we get to some questions here that have been submitted. Great. One of our first questions that we have is, do you have a recommendation of what requires sales tax and what does not? Or as far as a reference tool for folks to get, to look things up on?
The reference tool you can get from your state. And it's easiest to put in Kansas sales tax.
Great. That's an easy one to easily look up anyway. Another one that came in is, what's the best time to go through your records and throw them away? Or how long should we keep them?
Use the chart that you received. And the reason we say that, and this is the chart that everyone should have received, is because some records you keep forever, some you keep for 7 years. Your stockroom withdrawal forms, you toss those after a year. Your minutes, if you're a corporation, your minutes of your books of directors, stockholders, bylaws, and charters, you keep them forever.
Perfect.
So,
we will definitely get that out to those that participated today with it. And so we will send out an email that will go to those that were on. We had 60 people on today, so you guys will get some information yet today with it, and then we'll be able to go to the Department of Agriculture AFI website for the video and attachments later with that. A question on the difference between a business that's for-profit and a nonprofit. Are the rules the same, or do they have different things with them?
The rules are the same. The only distinction between a nonprofit and a for-profit is that a nonprofit exists to provide a service to the community, and a for-profit exists to create profit for the owners. They still have to operate like a business, and they still have to manage their books in a way that they can continue to do business.
Sounds good. About the beginning third of your presentation, you talked about capital equipment.
Mm-hmm.
What's the minimum amount of dollars in capital equipment that can be purchased that needs to be depreciated?
Well, that varies. You can establish your own. Some companies go as low as 500. And I say, based on the size of your business and how much large equipment you have, you probably don't want to go under 500, and 1,000 may be okay.
All right, sounds good. As you're working with people and talking with those, what is one of the main pitfalls in documentation issues that you see in small businesses that might get them in trouble?
I'll do it later.
Okay, then what's the second one?
The biggest one is I'll do it later. The second one is not doing it at all.
That works.
Yeah. And there are more people who do it later than there are people who don't do it at all.
Perfect. Another question just came in. Can paper records be kept as a digital copy instead of the actual paper copies with that? Can we scan them into a file and save
Yes.
maybe 2 places instead of just one, so in case something happens?
Yeah, as long as you have scanned the original.
All right.
There was some question at one time, and you may want to check with your accountant. There are little scanners that scan receipts in so that you can save them digitally. And when they first came out, there was a challenge because the receipts could be changed. But I think that's been addressed. So that's a good topic to discuss with your accountant.
Well, great. You covered a lot of wonderful information, and we're getting great comments submitted on that. With it, do you have a recommendation on what sales tax and what does, we talked about that one already. I should have checked that one off with it. We'll go to some other questions that came in with it. You talked about paying yourself. How do you do that for your business if it's your only source of income? How do I pay myself?
You pay yourself by owner activity. You actually say that it's an owner draw. Now, you will be taxed on the net profit from your business, whether you take it out or not. But if you need money to pay you, and for example, I live off my business, you just make owner activity and you do an owner draw and you transfer a lump sum from your business account to a personal account.
Got it. Well, good. A question came in as far as ease on taxing and that amount, as far as a service. Is it better to add that in to a flat amount? Maybe it's at $25 or $50 versus a flat rate, your regular, and adding the tax on top of that. What are your suggestions on that?
You can go either way. For example, I have books. I have, some business books. And when I am in a large group, I put the tax in ahead of time so that there's a flat amount that they charge, so I don't have to keep doing math back and forth. And people don't have, what they see is what they pay. The key is that you know how much is taxed, what your tax amount is.
Great. You talked about not doing bookkeeping, doing it later with that. So what do you recommend for someone who hasn't kept records and is attempting to remedy their records?
You set an appointment with yourself just like it's a business meeting every Friday at 4:00. And you spend 2 hours every Friday at 4:00 getting things in order. And once you've got them in order, then you spend every Friday at 4:00, and maybe it's only 30 minutes staying in order. But if you're not on top of things, if you don't set a time that you're going to do it, you'll always put it off. Like I said, it's not any fun.
No, it's not any fun. And we have a few minutes left. So participants, if you have a question, please put it in the Q&A. We definitely want to get to your questions with that. You talked a little bit about having a business account and a personal account for checking. So if you have a home business, is it better to have a dedicated cell phone number for that, a dedicated landline with that? How do you work through some of those pieces?
Well, I have a home office and I have a cell phone that is dedicated to the business. And if you want to reach me personally, you call my husband. The landline, there are certain things that are integral to the business, and that part of it, my business pays for. And the rest of it, is paid as a personal bill.
Got it. That definitely helps with that. You talked on credit cards. Credit cards, debit cards, where we're going to a lot of non-cash basis, especially in the last 15, 18 months with it. And recording a credit card payments for services, sales, accounts receivable, service fees for bank charges, net transfers for accounting accounts. How does that all play when you're trying to get it all done yourself or in a small business?
Okay, for example, I accept PayPal. I have just billed you $3,000 and you went to my website and paid it through your credit card. I have to record $3,000 in sales. PayPal will take out $90 in bank fees. So my deposit to my account, watch me do the math, is going to be $2,910. And my accounting entry is going to be $3,000 to accounts receivable and $90 to bank fees.
Okay, sounds good. And it looks like we've got some great software that's available out there, good financial folks helping from accounting firms, etc. In addition to going cashless, we've really gone to shipping, mailing, different transportation companies. So let's say we're mailing out, UPSing out, whatever, merchandise that has been purchased. How do you account for that expense? Where you have the product, you may have packaging, you have stamps or your
Okay.
charge on that. How does that work?
With the books, I charge, if I have to send you a book, I charge you $3 for shipping and handling. And I actually report it as income. Then when I ship it out, my freight cost to ship it out, I record that as an expense. And it may be $3, it may be $2.50, it may be $3.50. But I charge a fee for shipping and handling, just like Amazon charges a fee for shipping and handling.
Well, great. Well, we have had great information from you. Thank you very much. You really kept it simple for us to be able to follow along. We've had great comments on your presentation and just how wonderful things have been. So with that, I am going to turn it back over to Mark with it. And thank you very much. And thank you for those participants who've hung with us for the hour.
Thank you for presenting to us today, Ms. Heard. And thank you all for your participants who joined this webinar today. The next webinar in our virtual small animal series will be next Tuesday. That'll be on June the 8th at 12 o'clock with Dr. Kara Williams from the CDC on importing animals. We look forward to seeing you next week and have a great day. Thank you.